In a previous video, we talked about RRIFs and how to structure them properly and the different implications on structuring and beneficiaries. During that video, we also touched on the tax implications of RRIF or RRSP accounts. And essentially, what happens at the time of death, a RRIF is valued at the fair market value when the annuitant passes away. If there's no spouse to have a tax-free rollover or a qualified beneficiary, and you've named, say, a child or a sibling or a friend as the beneficiary of your RRIF or your RRSP, essentially what happens is the full amount of your RRSP or RRIF is claimed as income the year of death. So if you have $1 million in your RRIF or your RRSP and you pass away, you would have $1 million of income, and on average across Canada, that would be 50% tax bracket, and $500,000 of tax would go to CRA from your RRSP or your RRIF, and your beneficiary would essentially get half the amount. So let's talk about 3 strategies that you should consider if you have an RRSP or a RRIF in order to either melt down the RRSP or RRIF or protect it. The 3 strategies are spend it, melt it down, or protect it. Spending your RRIF is a viable strategy if you simply want to pull as much out of your RRSP or your RRIF as quickly as you can and essentially melt it down by spending it. The downfall of doing this is it often will cause an old age security clawback, and many people don't want to pull more money out, pay more tax, and cause clawback. The other downfall of this is you are going to prepay more tax today and essentially be pulling money out of your tax-sheltered investment early. Some people just want to melt down their RRIF this way, but it isn't always the most viable solution. The second way to melt down your RRIF is to try to find tax deductions on your tax return. So what a lot of people will do is they will borrow to invest. This creates an interest expense. And what they will do is they will pull offsetting income from their RRSP or their RRIF in order to offset the deduction that they have. Essentially, at the end of the day, what happens is you've pulled money out of your RRIF or your RRSP tax-free. The third solution is insuring your RRSP. So the $500,000 that we talked about that's owed to the government will still be owed to the government in the event of insuring an RRSP. However, what happens is that you would invest into an insurance policy. The insurance policy instead pays CRA, and you can feel the comfort of knowing that your beneficiaries will receive the full value of your RRSP or your RRIF. In subsequent videos, we will get into each of these 3 different strategies in a lot more detail. We'll show you some case studies and go through some numbers that you can apply to your own situation.